6 Ways to Value a Business. If you're thinking about buying a business, it's important to know how to value a business. This will help you determine whether or not the purchase price is fair and if the business is likely to be successful in the future. Here are 4 methods that cardiologist Brian C Jensen suggests you can use to value a business. 6 important business valuation methods according to Brian C Jensen. Book value. The book value of a company is the value of its assets minus its liabilities. Brian C. Jensen believes that this is a good starting point for valuing a business, but it doesn't take into account intangible assets such as patents or goodwill. Book value is calculated by subtracting a company's total liabilities from its total assets. Earnings multiplier method. Another method that Brian C. Jensen suggests is the earnings multiplier method. This method uses ratios to compare a company's earnings to its market value. The earnings multiplier is calculated by dividing the company's market value by its earnings. For example, if a company has a market value of $100 million and earnings of $10 million, its earnings multiplier would be 10. A higher earnings multiplier indicates that the market is willing to pay more for the company's earnings. Discounted cash flow method. The discounted cash flow, DCF, method estimates the future cash flows of a business and discounts them back to present value. This method is used by investors to estimate the intrinsic value of a business. The DCF method is complex and requires a detailed understanding of a company's financial statements. To find out the discounted cash flow, you need to first find the free cash flow. You can calculate the free cash flow by subtracting a company's capital expenditures from its operating cash flow. The capital expenditures are the funds used to purchase or upgrade equipment, buildings, or other assets. After you have calculated the free cash flow, you need to discount it back to present value using a discount rate. The discount rate is the rate of return that investors expect to earn on their investment. The higher the discount rate, the lower the present value of the future cash flows. Market capitalization method. The market capitalization method is the most common method used to value a business. It simply estimates the value of a company by multiplying its share price by the number of shares outstanding. For example, if a company has a share price of $100 and 100 million shares outstanding, its market capitalization would be $10 billion. EBITDA. The EBITDA method is a variation of the market capitalization method. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. This method values a company by multiplying its EBITDA by a multiple. The multiple is typically based on the company's industry and the current market conditions. It estimates the value of a company by multiplying its EBITDA by a multiple. The multiple is based on similar companies in the same industry. For example, if Company A has an EBITDA of $10 million and its competitors have an average EBITDA multiple of 10, Company A would have a value of $100 million. Conclusion. Brian C. Jensen has covered 5 different methods that you can use to value a business. Each of these methods has its own advantages and disadvantages. You should choose the method that you feel is best suited for valuing the specific company you are interested in. Thanks for watching.